Welcome and thank you all for joining us for this episode of the Crexi Podcast, an insider's look at all things commercial real estate. I'm your host, Yannis Papadakis, Business Development Manager at Crexi. In this show, we cover a broad range of topics, both to cater to commercial real estate newcomers and industry leaders alike. Now, today we are thrilled to sit down with Alex Sharrin, co-head of corporate capital markets and net lease at JLL. A little bit about our guest before we jump in. Currently sitting in the Miami office, Alex Sharrin has spent almost 8 years with the firm. He joined JLL's corporate capital markets and net lease platform as an analyst in 2015 in Chicago, and has been an integral part of the team's success and growth over the years. Alex focuses on investment sale advisory, alternative financing solutions, and build-to-suit structures for single and multi-tenant net lease real estate owners across all markets, product types, and geographies. His clients include developers, public and private funds, corporate occupiers, high net worth individuals, trusts, REITs, 1031 exchange investors, foreign capital sources, and family offices. He has closed north of 500 transactions totaling over $4 billion in deal volume since being promoted to producer in 2018. Alex, welcome to the podcast.
Thank you, Yannis. Pleasure to be here.
We just covered your background. I'd love to briefly learn a little bit more about your career path and some lessons you learned along the way. Can you tell us more about where you're from and how'd you get your start in commercial real estate?
Yeah, so born and raised in Chicago. I grew up in the city. I went to a private high school called Francis W. Parker, which I think is important because my high school experience really shaped a lot of who I am today. Francis Parker is an interesting school, and I kicked and screamed when my parents made me go. But it's a progressive school that really focuses on public speaking and the ability to write. I think both of those are very much lost arts today, and I think that for me, growing up in that private school setting, we never took a standardized test. The curriculum was not geared towards the ACT or the SAT. And so what happened was I fell way behind when I went to school. And I applied to colleges, and college counseling asked me, hey, Alex, we want you to go to the East Coast. Here are a few liberal arts schools we think meshes with our curriculum best. And for me, it was, I want to go somewhere with a good business school. I want to go warm weather. I wanted a good city. I wanted camaraderie. And so I applied to the University of Texas at Austin, which back then was much easier to get into than it is now. But I soon realized once I got to UT that not only was I not going to get into the business school, given my past in high school and my dealings there, but I was not prepared for school one bit because those major universities teach towards a test. And so I kind of fell into an urban studies and urban geography track early on. So nothing to do with real estate, nothing to do with business. And so when I got out of school, I had no idea what I wanted to do. I surely didn't want to do anything in geography, but I kind of looked back and looked at where my friends were and where my parents were, et cetera. And I've always been fascinated with maps and the streets. And my father was an office tenant representation broker in Chicago. And through my internships over high school, he always used to teach me how to canvass, how to knock on doors. And then when I was learning to drive, he basically said, Alex, you're not able to get your license until you basically memorize within 20 miles of where we live, every street, so that if I say go to XYZ, go to the corner of Fulton and Green in Chicago, you can take me there without looking at your phone. At the time, Google Maps was taking off, et cetera. And so what I realized was in real estate, there were a lot of people who knew how to do numbers, but there weren't a lot of people who knew what they were talking about and they could visualize all four corners of an intersection. And so I took that to my advantage, and I went and knocked on every door that I could. And I said, hey, I'm Alex Sharrin. I'm interested in getting into real estate. I have no prior experience whatsoever, but I'm here to hustle. And I think I know a thing or two about at least Chicago in general. To which case I got rejected by pretty much every single firm that I applied for. I then went to the phone books of my high school and my camp and everything else where I grew up. And I called parents, friends, etc. And I just said, hey, I want to learn about getting into real estate. I didn't know whether it was property management, capital markets. I didn't know whether it was leasing, tenant rep, etc. And the common denominator I kept hearing over and over again is, Alex, you got to learn the numbers behind the real estate. We know you can sell. We've known you could sell since you were 8 years old, but what you don't know is you don't know the finance. And I said, okay, so what do you want me to do? And some advice I got early on was, Alex, you got to go into a big brokerage house where they can kind of teach you through a rotational program. And so for me, that was JLL, that was CBRE, that was HFF, that was Eastill, that was Cushman Wakefield. And I pretty much went rampant, calling everyone I could at all of those firms. Didn't get a call back from anybody but JLL, who said, Alex, we're starting this startup within a Fortune 5 company. And it's the corporate capital markets and net lease team. And we know you don't know anything about real estate, but we like your personality and we're willing to give you a shot. And so that was kind of fast forward until 2015 when I started my career.
Awesome. Wow, what a story. Did you have some mentors along the way that kind of guided you or helped shape your career path?
Yeah, I think there was two. One being my uncle Seth, and my uncle Seth never went to college. He'll say he got a degree in frisbee, and he followed around the dead. But my uncle Seth is the hardest working guy that I know, and he was an auto mechanic and did odds and end jobs in the late '70s, early '80s in Chicago. And he worked on a building at 908 West Madison, which is Fulton Market, West Loop of Chicago today, which is absolutely booming and thriving. It's probably one of the hottest submarkets in the country. And in those days, in the late '70s, early '80s, you did not walk along Madison Avenue. It was dangerous and you shouldn't go there. Well, my uncle worked a few buildings around the area doing odds and ends jobs, like I mentioned. And there was a group called Gold Coast Tickets, a ticket brokerage in Chicago that was opening up shop in one of the retail kiosks. And my uncle Seth had beaten the principals of the ticket office to work every day, and he stayed later than every night. And then he'd go get beers with them after work and formed a really good friendship. And in 1982, 1983, they offered my uncle a partnership in the ticket brokerage. And he scraped together what money he could, borrowed from his dad, and became partner in Gold Coast Tickets. Now, this was off of work ethic and merit. And then in 1984, the Chicago Bulls drafted Michael Jordan, and the ticket business went booming. And I say this and why he was a mentor, because he still works 7 days a week, to this day. But I think that he got lucky with Michael Jordan being drafted in '84 by the Chicago Bulls and his career taking off. But he created his own luck with hustle and work ethic. And I think that holds true with a lot of people and where they sit, certainly myself in my job today. And then the second would be Keith Jaffe, who is a great family friend and mentor. He's been like a second father to me this day. My story at JLL is a little bit unique. When I started in 2015, there were about 4 or 5 people on the corporate capital markets and net lease team, very much focused on the corporate capital market side of the business. And when I say corporate capital market side, I mean sale leasebacks, lease monetization, build to suit capital procurement, etc. Now, what I do today is a lot in the private capital space, and that was non-existent to JLL at that point in time. And there were 2 guys who were my bosses at the time who worked in the private capital space and were trying to get that team off the ground. Well, both of them weren't having much success. And in 2017, they said, hey, Alex, we need help getting this off the ground. You want to join us? We'll give you 3% of everything that we make. Every dollar that comes in the door from us, you get 3% of, and you're going to be our junior guy. And let's go. Let's do this. And for me, I was 24 years old. I didn't know whether, 20 grand was good, 100 grand was good, or 500 grand was good. And I was just excited to get the opportunity. I was a sponge at the time. So I said, Absolutely, let's go. Well, 6 months later, one of the two went to private equity. The other one moved out of state and away from JLL. And here I sat in 2017, June of 2017, basically as the only one in the group doing private capital and not knowing where to go and not knowing that I had a place within the firm. At the time, I had went to JLL leadership and I had said, "Hey, I think I can do this. Give me a shot." To which case they said, "Absolutely not. You're 24 years old. You have no idea what you're doing. The guys above you were not that successful in their craft. I'm sorry, but you're going to have to find another job." So I went out to the job market. I interviewed with a myriad of different shops. I was very close to taking one. And then I decided, okay, before I take one, I want to ask again, JLL, will you please let me do this? Same answer, no. I remember I had dinner with Keith Jaffe, who to this day, as I said, remains one of my best family friends, a second father and mentor to me. He is in both private equity and real estate. And he said, "Alex, people like something with a little umph on it. So why don't you go back a third time and ask them, but tie something to it?" So I went back to JLL a third time and I said, "Look, I understand I'm 24, even though age defies nothing. And these two people above me were producing X amount. It's June of 2017. If I can hit what one of them were producing in half a year, meaning 6 months from June of 2017 till the end of the year, you got to keep me." And that's really how I built the corporate capital markets and net lease space in the private capital arena. And it's been very successful ever since.
Awesome. Wow. Um, it sounds like you've got some interesting, fundamental tenets when it comes to work ethic. Would you share what some of those are?
Yeah, I think one really important one is be consistent in who you are. I think a lot of people heed a lot of advice from a lot of people, but you are unique character and you're always going to be somebody's cup of tea and you're always going to be not be somebody's cup of tea. And you just got to stay true to yourself and the clients will find you and you'll work with clients that you want to work with. I think that another thing I learned early on is that it's easier for millennials in general to email and use technology versus to pick up the phone. I have always, always, always thought that picking up the phone was the best way to go and still do it to this day. I always thought that being the best communicator was going to make you the most successful. And this does not mean being the first one to get back in 2 seconds to an email or a phone call, but setting expectations right away with whomever, be it your client, your wife, whomever it is super important. And then perhaps the most important thing, which I feel like is lost on not only the real estate community, but most verticals, in professionalism as it is just to say thank you all the way up and down the water column, from the intern to the CEO. Thank you. Those two words are probably the most powerful two words in the business. And just picking up the phone for 2 seconds to say that, whether somebody does a little task for you, you just went into a big pitch, or somebody was kind enough to bring you a cup of coffee, I think goes a really, really long way about character.
Awesome. Well, let's jump into our talk about the net lease retail group and take us back to you're 22. Um, you just got started in the world of commercial real estate, all the way to today. Where you're leading net lease nationally for JLL. How did you do it? What skills does it take to build a team and lead it to success?
Yeah, I think I've always won with service and hustle. I think that how you follow up with potential clients is how you'll likely work deals in the marketplace. Um, I think one skill that I really, really learned early on was relinquishing control is probably the most important thing that you can ever do. There's no I in team. Uh, you rely on your teammates for pretty much everything. But to that end, I think it's really, really important for a lot of people that are just starting out in real estate. Real estate is an enormous industry, and it's really easy to get pulled in a bunch of different directions. But I think it's important to really stay in your lane. So for me, that was single tenant net lease deals. There were times earlier in my career where I got pulled to do multi-tenant office or multi-tenant retail, or I wanted to do JV equity structures, or I wanted to learn financing. And I think it's important to have an understanding of all of those elements on a macro level, but you're never going to be ultimately extremely successful if you don't know your craft better than anybody else. And then a couple more things I would say is working harder is not always better. Working smarter is probably the best way to go, and I think a lot of that relies on your teammates and putting the best team on the field. And then find your competitive edge. For me, I thought that my organization, my attention to detail, my ability to juggle a handful of tasks at one time ultimately set the competitive edge. And I think that in net lease, there's a lot of folks out there that did not grow up with a quantitative background. So there are a lot of people that were just given a desk and a phone and said, go. And I think that there's been a number of really, really successful producers, a lot of my peers at different shops that have come up this way. But for me, I going back to day one when I had interviews, it was always about, hey, Alex, learn the numbers behind the real estate so you can advise your clients in the best way possible in the future. And so that was always super important. And that I feel like sets a competitive edge for me in the net lease marketplace today. I can understand the capital stack. I understand how to underwrite a balance sheet. And my clients appreciate that when it comes to advice on the front end and on the back end.
Alex, as a broker, what skills or work principles do you think sets you apart from the competition that has led to such rapid growth?
I think a few things. I think one, JLL, we have an immense amount of data at our fingertips. So being able to leverage tentacles like research and corporate solutions, tenant rep, leasing, property management has been incredible. It's never been, as I mentioned, only me. It's really team. I think that relatability and likability are two ingredients that pretty much define the recipe for success. So, as I mentioned, you're not going to be everybody's cup of tea, and it's important to rely on relatability and likability. I think that it's really important to know when to move on with a potential client when you're just not meshing. Organization, client calls, remembering birthdays, notes in your phone book that are not relating to real estate are paramount. And I'll just go off on a sidebar for 2 seconds. And this is something that I do that's pretty unique, and the feedback from clients has been just tremendous. So I advise all listeners out there to go ahead and do this, because the little things sometimes win you over the big clients. Being an active listener is probably one of the most important things in real estate. And it's not always listening for, hey, what are your levered IRR return metrics? Or, how far are you into deploying XYZ fund? Sometimes it's as little as, hey, it was my birthday this past weekend, and making a note that it's your client's 40th birthday or whatever it was this past weekend next to their phone. Or, hey, my daughter just scored the winning goal on her travel soccer team this past weekend. And a lot of people just overlook that stuff. I've learned that that's the most valuable nuggets of information that you can have, because at the end of the day, this is a people business. And if you want those people to come back and work with you based on the relatability and likability factor, you're going to remember the personal anecdotes. It's not always about the professional anecdotes. So again, really important. This is a people business first and foremost, and the little things will win long term.
Absolutely. Details and being able to pay attention to and catch details really matters. Tell me, how on the business side do you create the most value for your clients? We talked about how to exceed their expectations when it comes to, listening and, identifying and chasing opportunities? What keeps them returning for multiple deals?
I think being a market expert in your field and not deviating. So for me, that's been really understanding single tenant net lease real estate, asset class agnostic, can be retail, industrial, office, medical office. I'm really in tune with the net lease market and the fixed income alternative space and where that type of group of investors likes to behave and where their yield parameters, thresholds change over time. I think the second would probably be making friends with your clients based on all the personal anecdotes. I think that probably creates more value for your clients than people think. At the end of the day, people do not want to talk to robots, they want to talk to humans. And then the third, and this has propelled my career in ways that I never thought possible, but private capital has become my namesake. Um, Private capital and institutional capital as an investor subset within real estate have always been two separate buckets and have always been perceived as two separate buckets. I think since I started my career in 2015, every single year the lines have blurred between private capital and institutional capital in ways that I think were unprecedented and that the market was not prepared for. So that's the high net worth individuals, the family offices, the 1031 exchanges of the world, the foreign capital, and being able to track those very elusive forms of capital is what creates all the value for my clients on a day-to-day basis. Most of these 1031 individuals or high net worths, family offices, they do not want to be found and they prefer it that way. So if you are able to add value to your clients by knowing where they are, how to find them, it can change the game and get you a client for life.
Can you share any of your favorite transactions throughout your career? Why was it your favorite and what made it unique?
Yeah, I'll share a couple. So one was a couple of years ago. We sold the building in Lincoln Park, Chicago, 2720 North Clark. It was actually a three-tenant building, but it played very much like a single-tenant asset. It was a Chicago public school on the second floor and Amazon and Banana Republic on the first floor, all under net leases. Again, very much my bailiwick. And it was a very difficult time to get deals done. And we had to get very creative with how to bring folks together. And when I talk about adding value in the private capital arena, it's not only adding value in so far as finding them, but getting certain private capital individuals to trust each other on a surety of execution basis takes it to another element. And so this was a $9 million sale, so a rather small, net lease transaction. But I knew of two 1031 purchasers. So they had both sold other assets and wanted to defer capital gains into something else. And they didn't know each other. One was from Florida and one was from Chicago. I knew both of them. I introduced them and had them buy the asset together, to which they still own to this day. And we financed the deal with a TIC structure, so tenants in common structure, through the CMBS market, which is rather difficult. The CMBS market does not want to see tenants in common structures. And it got the deal done for our client in a very difficult time. And I think our client was just wowed with not only do we find the elusive 1031 buyer, but we found two of them and brought them together and financed the deal.
Got them in the deal together. Wow.
That's correct. So
that is a rabbit out of a hat.
Yeah. So that was one pretty awesome case study that I'll never forget, and a very arduous and difficult process, but a very happy client. The second was also. Go ahead.
Before you go on to the next, I'm curious. So when you introduced them, what was that like? Did you take them to dinner? Did you guys go golfing? What how do you even approach that?
That's a good question. So a lot of it has to do with reputation, and that I wouldn't be calling and letting these two folks know that they should be doing deals together if I didn't establish some credibility in the marketplace. So that was huge. But a lot of it was relying on our team and our data and showing them deals in the $3 to $5 million price point, none of which either of them liked, and finding a commonality that they both wanted to scale a little bit to get to better yield thresholds. Because remember, as you go up in price in the private capital space, you're more than likely has an inverse relationship with your cap rate. So not a lot of folks have, more and more money. So when you get into a $9-10 million price point range, you're dealing with more sophisticated private capital, both of which these were sophisticated individuals. I set up an introductory phone call. I said, hey, Steve, meet Win. Win, meet Steve. You guys have both been very great, long-standing clients. I found a common element that linked both of them. In this case, it happened to be golf and the love for the Chicago Cubs. I used that as a phone call as kind of like an icebreaker. They hit it off great. I scheduled a meeting for them to meet me for brunch in Chicago, and the brunch went fantastic. We went over the deal, and they remain partners to this day. So two more favorite deals, and I think this is important for the audience, and especially net lease, and on the theme of private capital and institutional capital, the lines blurring. But we were in the market with a single tenant Neiman Marcus building, flagship location on Michigan Avenue, downtown Chicago. It was $100 million asset. And our retail capital markets team said, hey, we don't know who buys this. This has got to be obscure private capital. The returns just don't meet the institutional thresholds and parameters. Alex and team, can you guys help us? And again, our competitive advantage in the space is knowing how to track elusive capital. And so I made a call to a fellow who I'd done a deal with, who I knew was selling a tract of land to Taylor Morrison, the private home developer out of Scottsdale. And they were selling the tract of land for $50 million. And this is how private capital works, because I don't know this guy if he didn't buy a $3.2 million Office Depot from me a year and a half ago, but he happened to buy a $3.2 million Office Depot from me a year and a half ago. And a lot of people think, oh, he's bought and sold the $3.2 million Office Depot asset. He does not have the funds for a $100 million deal. And I think that that's where the market's changing, and people need to wake up and realize, because that same buyer who bought my $3.2 million Office Depot in a trade, we had him on our list, and he ended up purchasing a $96 million Neiman Marcus asset, flagship, downtown Chicago. And he was on nobody's radar. And he had sold a tract of land down in Houston, as I said, to Taylor Morrison, had a big capital gain event, and just wanted generational real estate. And so again, we're pulling a rabbit out of our hat for a good institutional client of the firm, and they could not have been happier. And then the third, we set a few record deals during the pandemic, and they were really, really fun to work on. But one in particular was, we sold the Walgreens down here in Miami Shores, and Walgreens record cap rate prior to the pandemic was a 4.38% cap rate on an infill deal in Las Vegas on the Strip. And we ended up selling the deal for a 3.69% cap rate to a private investor out of Los Angeles, who happened to be in Miami for Art Basel and had just sold her skincare company to L'Oreal and wanted a sexy flagship asset in Miami, and was no joke down here with her girlfriends, and said, you know what, I'm going to take an Uber up there to Miami Shores. I love the real estate. Uber back down to the design district and closed 2 weeks later.
Wow. Incredible. I remember seeing both the Vegas deal and yours when they were on market. I was tracking drugstores at the time, and incredible cap rates they traded for. And congratulations for hitting that high water mark, or I guess low water mark in terms of cap rate.
Yeah, correct. Thank you.
All right. So getting into the nuts and bolts of commercial real estate today, I'd like to ask some questions about net lease a little more generally. What's your 35,000 foot overview of the net lease sector today?
I would say that, first of all, the net lease marketplace is very important to understand, sits at the nexus of real estate and credit. And what I mean by that is when people are interested in purchasing or selling net lease business buildings, they look at two things. They look at the strength of the guarantor on the lease, so the credit, and that could be anywhere from a lower to middle market credit company, just call it, $500,000 in EBITDA, all the way up to an investment grade credit tenant. You're talking about the Walgreens of the world, et cetera. And then they look at real estate fundamentals. So what does the strength of real estate look like? How's the rents relative to market? All of that good stuff. And so that net lease business, right, at the intersection of real estate and credit is really a fixed income allocation. So people are looking at it as a diversification of their equities portfolio. When you go out and you buy Amazon or Apple from the stock market and you expect to earn 4, 5, 6% because you're buying a blue chip stock, that's the same type of investment that folks think they're making in the net lease space, just with tangible assets in real estate and some added benefits like depreciation, et cetera. My 35,000 square foot view of the net lease space is really positive. If you look at the new entrants to the marketplace over the last 10 years, it's been pretty unprecedented. Private capital has 20x their allocation into the fixed income sector in net lease. And I think that real estate fundamentals are at an all-time high. I think that one thing, when you look at that bell curve of real estate and credit that we're seeing now that we didn't necessarily see before, is that real estate is becoming more and more important. And what I mean by that is that bell curve may have looked something like 50-50, but today it's more like 80-20 trended towards real estate. Investors are laser focused on residual and go dark value, what happens if the tenant leaves. And so secondary, tertiary locations that have good credit are probably taking the biggest hit in the net lease space, whereas strongly located real estate with palatable and or below market rents are still holding up cap rates even to what they were in the pandemic.
Right. And I mean, it seems like since the pandemic, the flight to safety has really panned out well for net leased assets, especially if you're in a 1031 exchange. Looking for high quality net leased assets hasn't gone out of style. In fact, it's probably become more popular. So where we're seeing some, cap rate expansion among other product types, we're not really seeing that with net leased, are we?
I think it depends in which bucket, right? Net lease is asset class agnostic. You have retail, you have industrial, you have medical office, and you have office. I think that in office, there has certainly been some decompression in cap rates, maybe to the tune of 100 to 150 basis points. In industrial, there's been some decompression in cap rates, but not nearly as much. Retail, the balance of power has completely shifted in favor of the landlord. You look at bankruptcies like Bed Bath and Beyond, and you think that would be spun in a negative light, but that is probably some of the most positive news that the retailer world has heard, because corporate occupiers not only have their foot on the gas pedal, they have their foot on the accelerator to expand into space. And so retail fundamentals remain extremely strong. And then medical office, which, you'll touch on it later, I believe, but I think that their medical office has been a little bit of a dark horse within net lease real estate, certainly, in the last 5 years. What I mean by that is we have seen an unbelievable amount of retail investors start to trend into investing in medical office buildings. And you kind of ask the question, why? And the answer is strictly because the in-place lease economics are much more favorable in medical deals. They're used to, office leases, and those tend to have 2.5 or 3% annual bumps. Whereas a lot of the retail tenants, maybe it's flat, maybe you have a 5% bump every 5 years, maybe you have a 10% bump every 5 years. But then you also look at the mission criticality of the space that the corporate occupier is eventually using, and the dollars invested in that space. And from the medical perspective, the dollars invested and the licensing that go into actually being the end user in the space are far more and far outweigh the retail. And so when you take all that, you put it in a blender, and then you look at the trends of when you or any of the audience go to, the doctor's office, you'd rather it be, an outpatient facility right next to your Chipotle at the corner of X and Y than you would to go into a parking garage in a hospital and go to floor 7 and take the escalator and then walk across the road and find your door. It's about convenience and surety and ease of that convenience.
We've touched on this a little bit, but can you expand on how net lease has evolved and changed in the last 5 years?
Yeah, I think we did touch on it a little bit. I think the major thing is private capital. Private capital has just become the darling of net lease, and I think that investors are very much looking at a fixed income allocation and saying, hey, where else can we deploy this? The stock market's been a little bit stagnant. The Rolex market's outperforming the stock market. Where can we go to get this sort of same flight to safety, flight to quality type return? But we can tell our friends that we own a building, and that's in the net lease space. And I think that also, go ahead.
Oh, no, go ahead. Finish.
I think that the other thing that's different, I'll just call it 5 years ago versus today, is that the corporate occupier is getting a lot smarter. What I mean by that is that developers were making a lot of money on developing buildings, specifically in the retail and industrial arena, for corporate occupiers that just needed space and did not pay attention to the economics that the developer was building to. And so these developers were making 250, 300, 400 basis points of spread off of what's essentially a bondable lease that's their credit. And so a lot of corporate occupiers have woken up into an open book model, which a lot of developers don't like, that basically says, hey, Mr. Developer, we know your cap rates are selling, our credit's selling at a 5% cap rate. Therefore, you're going to build to a 6.5%. You're going to open book it. That spread's going to be 150 basis points. If you don't like it, we're going to move on to the next developer. And we're seeing that trend all over the place.
Do you have any hot takes or controversial thoughts about the current happenings in the market you want to share?
I think the biggest hot take is that medical office will continue to be a burgeoning vertical within the net lease sector. I think that another hot take is that corporate occupiers will start to profit share on their new deals. I think that a lot of them, when you look at their reporting to Wall Street, definitely need cash to maintain liquidity ratios. And one way to do that, especially when their foot's on the accelerator and opening new space, is to say, hey, Mr. Developer, I know you want to build to 200 basis points, but how about if we profit share 50-50 over, an X? So I know you're going to sell it. We think our credit sells at a 5. You think our credit sells at a 5.5. What do you say that if we get over a certain number, we share in the upside 50-50? That historically has never happened between the corporate occupier and the landlord, but I think it's a creative way to both help the corporate occupier get cash on the balance sheet and to align incentives with the developers.
Next up, what are your primary considerations as you advise clients through current economic times? Like, where are long-term upsides? What are the current obstacles?
Yeah, I think strength in real estate is really where I'm advising my clients. If you look at where people have gotten hurt in the net lease space, it is looking for yield and chasing yield. What I mean by
And
that,
do you mind drilling down a little bit on strength? What are the fundamentals that you're actually looking for?
sure. So strength in real estate really meaning if you had that box or that building and that tenant went away, would you have a line out the door to fill that box or that building tomorrow? And I think that's the question that I ask my clients before they purchase real estate every single day. And I don't think it's a question that people ask enough because, again, they're looking at yield parameters. But at the end of the day, real estate is a location business. That's why you hear, the same adage, location, location, location over and over again. So my advice very much to clients is focus in on strength of real estate. It'll always carry the day.
And then current obstacles. What are you seeing that's a challenge right now in the market?
Yeah, I think the biggest challenge, and this is not only net lease, but the marketplace in general, is the debt capacity, and just whether it be your local regional bank or larger lending institution, be it a life co, money center bank, CMBS, the ability to lend and the surety that those dollars are there and that the field is there and the lending community is becoming a little bit more scarce as the day goes on. I think that everybody would like to wave a magic wand and say, hey, June 1st, things are going to get better. I think that we ultimately will see an accelerated recovery. And that accelerated recovery does not mean that cap rates will get back to a place that they were 9, 12, 15 months ago. I think the accelerated recovery will be made by the debt markets opening up again and there being price discovery in the ability to lend. And so that remains a huge obstacle. I think if you look at the forward SOFR curve, you look out 24 months and it's expected to come down 200 basis points. So we're at I think the 30-term SOFR is at a 5.15% today. So if you look out in the forward SOFR curve and you can Google and use any of those metrics, I think that in June of 2025, it's expected to be around 3. So if you look at that, that's a good indication of what should hopefully be to come in the future. This market is not the great financial crisis. There's a lot of, there's a lot of variation between what we're going through now with the debt ceiling crisis and labor than we were in the great financial crisis. And there's a lot more liquidity in the marketplace than there was then. There is no liquidity crisis in the marketplace. And so it'll just be the opening of those debt markets in order to kind of flood transaction volume again.
All right. Moving along to our fourth topic. Given your specialized background and expertise, I'm sure our listeners are curious about your answers to a few, rapid fire, words of advice questions. You ready?
Yeah.
All right. If you were given $50 million today and had to invest it immediately, what would be your go-to asset type and why? And
So
where?
I would.
Are you looking for that super low cap drugstore in Miami?
I'm not looking for that super low cap drugstore in Miami unless it was paying rent that was 300% below market. So if I was to deploy 50 million today, believe it or not, and be in retail, and it would be A corners in growth markets. So personally, I'm a big fan of burgeoning markets in the Southeast in the Sun Belt. I know a lot of investors are out there, but I would find buildings where I didn't necessarily care about who was in them, but they were the best corner in that marketplace. So an example of that would be an old Arby's that was on 1 acre of land in Jacksonville, Florida, in St. Johns County, in one of the most booming counties, Jacksonville. And market all around the Arby's is paying, 30, $40 a foot. But this Arby's inked a lease in 1987 and they're paying $11 a foot. Now they have 2 5-year options remaining on their lease, so they're not going anywhere. But in year 11, they're quote unquote naked, have no more options, and you're able to either say, hey, Mr. or Mrs. Arby's franchisee, you either need to roll the market or you need to get out because I got a line out the door of tenants that are going to, take the space. And so again, going back to what I said before, I'm not focused on yield today. I'm very much focused on ability to create yield tomorrow. I'm 30 years old. So if I had $50 million, I would be looking at opportunities that didn't necessarily garner me the extra, umph today, but in the future.
Favorite tool or software you use on the job? And this isn't a trick question.
Of course, Crexi, but I'm a huge LinkedIn fan. So every deal I close, I pound my chest and I post it on LinkedIn and I tag all of my teammates and I write a funny little quirky caption about the deal. I don't just say, hey, we sold Walgreens in Miami Shores. I'll say, this is Jimmy Butler's favorite drugstore or whatever. Get the crowd laughing a little bit, and kind of create a good time, because at the end of the day, you need a little humor in your life.
And then what's the most common misconception about your job or industry?
I think that the common misconception from the broader real estate community is that the net lease marketplace is easy. And I think it's probably the hardest vertical within commercial real estate to get into, because it has the lowest barriers to entry. So to sell net lease real estate, you really do only need a desk and a phone. For the most part, it is very simple. You have one tenant, you have one rent. The rent encompasses all of the triple net expenses. So the landlord has no burden but to collect the rent, and you sell it on a cap rate. So you are basically dividing your net operating income, which equals the rent, by a cap rate to get your value. So again, it is not rocket science, but net lease probably has the most competition amongst brokers, developers, architects, tenants, etc., than any other space within commercial real estate. And so I think a common misconception is that it's easy to just do net lease, where I think it is ultimately very, very difficult.
Finally, as we're wrapping up here, we're getting to the end of our time. Any parting words that you'd like to share with our audience before we go?
Yeah, I think, and this is speaking to folks that are really just starting out in commercial real estate, or it can pertain to people who have been doing it for a very long time. But organization and planning your day are extremely important, and finding time to do things that aren't real estate related throughout your day are going to really help your career. So for me personally, every morning I go on an hour walk with my wife and dog. I leave my phone at home, and it is our time to just catch up with one another and be humans, and to not be distracted by every email that's coming in. And then the other thing is to be active. So I let my team know, whether they're in California or New York, that if they need to find at any time in the day an outlet, go to the gym, go on a walk, go on a run, do whatever you need to do to get your mental straight, because otherwise you'll burn out. So I'm a huge proponent of getting your fitness in, and the work can wait. Your work product's going to suffer if your mental's not right. And so being active is extremely important.
It really is. What do you do for, aside from walking, you go to the gym. What do you like? Cables, free weights, resistance?
I like it all. I used to be a big boxer.
Oh,
So that was a great way to get my cardio in. Down in Miami, now I've picked up tennis, which has been great. I always get mad at my dad because I'm 5'7" and played basketball my whole life, and he didn't tell me that I wasn't going to grow past 5'7". So I missed out on the chance to play tennis or golf or any of the other sports that you don't really need to be tall to be good at. So I would say boxing and tennis and free weights and just going on long walks with my wife is good enough for me.
Nice. Alex, thank you so much for joining us and sharing your insights. I know you're really busy, and we appreciate you spending the time with us and sitting down.
Sure. Thank you.
And where can people find you online if they want to get in touch? Email, social media? I know you said you're big on LinkedIn.
Yeah, you can follow me on LinkedIn, Alex Sharrin. My email is alex.sharrin@jll.com. Feel free to reach me anytime. And my Instagram handle, we are working on that. It's in the works to get a corporate capital markets and net lease Instagram handle, but I'll share it with you all when the time is right.
Awesome. Well, thank you. And thanks to everyone that tuned in today. If you enjoyed this episode, do not miss the next one. Visit go.crexi.com/podcast and sign up to get the next episode directly to your inbox. Of course, you can also subscribe to the Crexi Podcast on your favorite podcast app, and you can check out our YouTube channel for videos of each episode. Thank you all. Take care. Be well. See you next time.